Welcome to the coffee shop, everybody. This is your host and barista. Hold on, let me pop my screen open. Hey, there I am. What's up, everybody? And this stuff here, all of that stuff taking place there, that's a whole lot. Today, you guys are gonna learn something. You're gonna learn today, okay? What I want to talk to you guys about real quick in today's video is going to be high liquidity and low liquidity pivots. And for this, you don't need an indicator. You do not need an indicator. This is going to be a price action masterclass. You guys have been asking about when I'm doing another masterclass. Where's my finger? My finger's over my face. There. Can I get there we go. This is the masterclass, all right? So I want you guys to just kind of hang out, pause the video, go into the kitchen or your office or whatever, grab yourself a drink because I've got mine. And you like my new mugs? My mugs are yellow on the inside. I've got other ones. This one's yellow on the inside, like my RSI. How you like that? So in today's video, we're going to be talking about high liquidity and low liquidity pivots. And let me define what they are. When I say pivots, I'm simply talking about price levels. Okay, price levels. I'm not talking about a pivot indicator. And the reason I say do not use an indicator to do this strategy. This is a strategy, okay? I want you to understand something. When you go to TradingView and you look for a strategy is not taking this indicator with that indicator and settings here and settings there. Those are not strategies. That is just follow the leader. That is just look for the color, look for the cross, look for the signal. That is not a strategy. A strategy is price action did something, okay? Price action did something. Now it's doing something else. So you look at the previous price action, okay? You look at the past price action and you develop a strategy based off of what price did. That is a strategy, okay? So this is going to be a strategy and you guys are going to learn it. All right. This could be a little bit long and I just want to try to get through this very easily for you. Okay. So high liquidity and low liquidity pivots. What are they? All right. So we all know pivots usually look like pivot levels, right? So there's some purple and green ones. Okay. But the reason you don't use an indicator for this is because this is simply plotting out a price swing. The difference with this is Pivot indicators, they will simply draw out swing highs in an uptrend or swing lows in a downtrend. The difference with liquidity pivots is they're doing the reverse. And this is why I am creating my SMC indicator the way I am. And in this video, I'm kind of giving away my secret sauce of what I'm looking for. Okay, the liquidity that you're looking for is basically whether it's a swing point in price that is either going to go right through, like price is going to go right through it later on, or price is just going to get stopped by that swing point. So let me turn off this pivot indicator. You do not need indicators. Okay, so now let's get into this, right? Let's just kind of do this, stretch this out so you can see what's going on. You like my little candles here? That's nice. This is my little tool. We're going to use that today in today's video, okay? And again, you do not need an indicator for this. So do not go on TradingView and look for a liquidity pivots or market liquidity indicator. Don't do it. I'm going to show you how to see it visually, okay? And once you do this, once you get this class, this lesson plan, once you understand this, you can go ahead and put that liquidity pivots, right, on your chart. Go ahead. And you're going to see how many pivot points that it gives you that are wrong. They're just wrong. You will be able to look at the indicator and you'll know that it's wrong. So what's the difference between high liquidity and low liquidity? Okay. High liquidity, when price reaches a high liquidity area, price will stop. Okay. High liquidity areas stop price movements. Low liquidity areas allow price to move through them. So think of liquidity like this. Liquidity is the interest of the product that you sell. You know me, I like the coffee shop, right? So I sell cups of coffee, I sell cups of tea. I put, a new flavor, gingerbread castle tea flavor, because it's Christmas, with the foam on top. If there are no patrons in my shop, then I have low liquidity. Low liquidity. There is no one there at that point to purchase or be interested in my coffee and tea. Nobody cares, right? That is a low liquidity. High liquidity means there is a lot of interest, okay? So that means if a move is taking place, then there is going to be a strong move to move against it or just kind of buy it up. If I'm selling, there's going to be buyers. If I'm buying, there's going to be sellers. Like they are there. So now, using this lesson plan, you'll be able to look backwards in the market, right? And see where the high and low liquidity areas are, okay? So high liquidity stops price. Low liquidity allows price to move through it, okay? Now, the other thing you need to understand is that bullish candles make pivot highs. Bearish candles make pivot lows, okay? And that's just a rule that I have developed for myself when using a liquidity seeking strategy, okay? And the length of the wick on the candle will tell you if the liquidity is on the correct side or not, okay? So I want you to go into the description below, and you're going to see this and this. You'll see it down there. You can also get it on my profile at TradingView, and as well, you'll be able to get this information. See this down here. Am I marking that right? Yes. So you can see this down here, okay, at coffeeshopcrypto.net. Okay, that's going to be the website right there, down there. So we're just a couple of minutes in, and we're basically covering the whole points that you need to understand. This is the study plan. High liquidity pivots will stop price. Low liquidity pivots allow price to move through them. So now you need to understand what is the purpose of finding these pivots, okay? It's not enough to know where they are. You need to know what they're going to do, okay? High liquidity pivots, if price comes back to a high liquidity area and creates another high liquidity pivot of the same type, if you have now created basically the same type of candle in the same place 2 times, you are going to have a big move. You simply looked at the market, you found a place where potentially institutional trades were taking place or large volume trades were taking place, high volume, high liquidity, right? And from that point, price will come down to it and really just take off. That is your retest area. Price is going to just shoot right through it. Now, if you find a low liquidity area and price is coming to that area, you can best be sure that that is not the pivot level or the price swing level that you want to take profit. You can take part of your profit, take part of your order off the table and leave profits on the table for a high liquidity interception, okay? So now, it sounds like a whole lot, but I'm going to show you on the chart exactly what you're going to be looking for, right? So high liquidity, low liquidity, which ones do I choose? Well, that depends on what you're doing in the market, okay? So we can see that this move is here, right? And we'll just kind of go like this, right? We can see that we have a downtrend move taking place. I'm going to cut the chart right here. I don't really want to cut the chart because I don't want to have to replay it, but I'm going to do this anyway, right? We'll just get here, okay? There we are. Let me just kind of skip forward a little bit because I want to see this pull back up, okay? Because when you, see, now it's coming back up, right? Now, when you have a downtrend, this is the part that you want to know. When you have a downtrend, let it play out. Do your trades, whatever you're doing, okay? When the move changes, it goes from a range and it starts going into an uptrend, all right? When it starts going into an uptrend, this is where you want to look backwards in the market. You're here, okay? You want to be able to look at all of this, at the downtrend that took place, okay? And in here, you're going to find the high liquidity points. You can find all the price swings if you want, but look for the high liquidity points. So what do you look for, right, to find high liquidity? It's very simple. You're looking for the opposite candle. That's it. You had a downtrend, bearish moves, right? And I'll tell you, I'm going to show you why you just kind of negate the bearish candles. You have a downtrend. The momentum is already carrying down. So you don't care about the bearish candles. Don't care about that. Momentum is already carrying down. So I don't care about the wicks on this, right? The only thing I care about in a downtrend is the bullish candles, okay? The candles that closed long. Now, I'm going to show you why a pivot indicator does not help you with this, okay? Look at the pivots for a second here. I have these pivots set all the way down to a 2. Quantity pivots to remember 2, so he's going to remember 2. Pivot legs is how many candles to look at. It's looking at every 2 candles, right? But if you look, these are swing lows, right? Why is it not marking this low? And it's not marking this low, right? It's not marking all of the highs. It's not marking all of them. So pivot indicator is not going to help you, right? Not in the least, because it's drawing out too many and it's missing some. You don't know which are which. This is very easy to do just by looking at the chart. Now, here we go. You had a downtrend. The downtrend is over. You see the uptrend is beginning. You decided you're going to start taking a long position somewhere, right? At some point, you decided you're going to take a long position. I don't know, RSI, whatever. And you use your swing low, whatever your swing low is that you want to use, right? But you want to find your take profit areas. Look at the pivots. Let's just start with looking at all the pivots, right? You can see that you have a swing high here. But what did I say? I said you want to find the bullish pivots, right? But let's take a look at this one for a second. This is a bearish candle with a high pivot, right? This is not the pivot where you want to take profit. This is a pivot where price will easily break through that level, very easily. So if you want, you can target this immediately and put a lot of shares down, leverage if you want, go right to that point and get out. Bank that one, okay? But price will move through this. Why? Because the momentum is already down overall and you got a bearish candle. What you want to find is the bullish pivots that have a swing high, okay? That means the high of the bullish candle is higher than the high of the candles on both sides, okay? See? Here's a high with a lower high on one side, a lower high on the other side. You want these candles in a downtrend. That's what you want, right? And again, downtrend, you are looking for bullish candles. And what did I say? Bullish candles make highs. Bearish candles make lows. Now, there's one other thing that will tell you that you want these highs here, okay? Why am I taking this one as opposed to this one? It's a bullish candle. Well, it's very simple. I have a bullish candle, but the wick is longer on top. That's literally it. That's the trick. Done. Okay? Secret sauce revealed. There you go. I just blew your mind probably, and you could test this on any time frame. I'm showing you this in a ranging market, okay? We are in a ranging market on a 5-minute time frame. You can do this on any time frame, okay? Works awesome on a daily time frame, by the way. So, like I said, you are starting an uptrend, okay? You had a downtrend. Look backwards at the downtrend. Find the bullish candles with long wicks on top, okay? And these are going to be the areas of high liquidity. These are the areas that price will come to a stall, or these are the breakouts that you do not want to get involved in. And I'll show you exactly what I'm talking about. So here you have a long wick. This is resistance, all right? Let me kind of fix this here. It looks kind of aggressive. So this is an area with high resistance. This is another area. See this one here with high resistance. This has a high and 2 lower highs underneath. The wick on top is longer. It's in the downtrend and it's a bullish candle, okay? Bullish candle in a downtrend with a long wick on top. What you can do while this is happening, while this is playing out, is you can literally mark these candles, right? As price is playing out. Now, primarily, you want the candles mostly that are near the top of your swing points. Like you got a top of your swing point here. You got a recent bottom one down here, right? And even lower down here. Now, I'm not going to say, which ones do you choose? It's really up to you. It's like how far do you want to trade in the market, right? So again, long wick on top, bullish candle in a downtrend. Its high is higher than the other 2 highs beside it. Bullish candle in a downtrend. Here's a high and a high. but the candle itself has a higher high. Here is two high liquidity areas. So I would trade to the mid or to the top or to the middle of these areas. I would go there, right? I would find a comfortable place in here. If I'm doing a 1 to 2, see here, I'm at 1 to 1.65. If I take this pivot level down here, right? Let's go 1 to 2 on this one, right? I can go here, let's say. And you know me, I always want to pull back just a little bit and just kind of catch a nice little, safety net. I like using the RSI formula. I'm using this level here, which is this high that coincides with this one, right? So, and if you drew that out, you can see that you have a, right? You got a support and a resistance. I'm using this level. That's what I'm going to use. So I'm just going to go to this point. Now, I don't want to get into the details of where do you take your profit and stuff like that, but just practice your risk management. How much are you willing to lose? Okay. But I want you to see the areas that are significant. Now, there's a reason for this. Okay. A lot of people will see this pivot here, right? They'll see this. And they'll say, I want to catch a breakout of this pivot. Okay. That would be a big mistake because just below this pivot is a high liquidity area, which means a lot of trades are going to take place here and it's going to stop your price. So your price is going to go up, swing outside of it, false break, and come back down. You will lose. You will lose. Okay. Now, while this is playing out, you can even look back at the previous market. You had an uptrend. Let's talk about the alternate liquidity that you previously had. We were looking at a downtrend, finding the bullish candles. You have a small uptrend here. Okay, small uptrend. Look at the bearish candles, right? So you want to find the bearish candles that have a long wick on the bottom, okay? Because the move is happening upwards, right? And you can see you got higher highs and higher lows. So you can pick any in this area, right? Find the bearish candles with long wicks on the bottom, right? And these levels are relevant later in the market. They can be relevant right away or whatever the case may be. So long wick on the bottom, bearish candle has a low that is lower than the ones around it, right? Here's the low, here's a previous low, and here is the next low. You got a V shape. That's what you want, right? You don't take this. This is a low liquidity area. The wick here is shorter than the wick on top. So price later on will easily go through this level, easily go through it. Look what happens. You get a candle that closes below it. Price just kind of dances around and falls right through it. This is a low liquidity area because the wick, the longer wick is on the wrong side, and we're in an uptrend with a bearish candle, which is half correct, but you need a longer wick on the bottom, all right? Not a longer one, not a longer one. So you here in this, you can see that all the way through this, right? In this move upward, all you have is low liquidity areas, which means price is going to take all of this. It's going to sweep through all of this on the way down and get down into this level. So you see this level here, right? We have an uptrend taking place. I'm looking at the bearish candles, right? Uptrend here, nice long uptrend, right? And every time price breaks below a previous one, just look backwards below it. Look backwards below it, right? Uptrend. You have this one here. Price broke below it. Look at the next one. Go backwards below this. You've got this, right? It's not necessarily that far below it, so you don't take this one. Again, you have an uptrend taking place. Look at the bearish candles with long wicks on the bottom, right? And these are the levels that you're going to use for support. You don't have to find the ultimate one. You just have to find the ones that make sense. Now, here's how people get lost, right? I'm going to make this one a little bit thicker. Here, we'll do this. I'll make it like this and like this. Now, the reason I'm marking this one is because I looked even further backwards. I see a bearish candle, ultimately in an uptrend, but the long wick's on top, not on the bottom. So if I tried to go here with my, this is wrong, right? This is going to be a bad move. Okay. There. Okay. This is a bad move. You do not want to try and get a breakout of this level. When price continues traveling upwards and then starts coming back down to come back to this pivot level, this is where people get wrecked in the market. They get a breakout from here, okay? They get their breakout below this level, and price immediately pulls back away. Why? Because this is a low liquidity area. You want to trade and get out at an area where there is high liquidity, okay? So let's just take a look forward in the market and see what happens here. This is my last one. This is not a good one. I don't want to target this, okay? I would trade to this point or a little bit lower, but if there's a high liquidity area somewhere down here in the future. But if this is the only thing below my price, I don't want this. I don't want anything to do with this, okay? So let's see what happens. Look at this. Price comes down to this level, right? People are picking this swing point down here, and look what happens. Price comes down to this level, immediately reverses, and starts going back. Now, this would have been the good place. Get the breakout, get out. Just get out at this point. This is highly unsafe. This is very, very dangerous to do, okay? And let's see. So I drew a bunch of things on here. Let's get rid of a bunch of them, right? You want to trade to the high liquidity. If the only thing after high liquidity is low liquidity, you can expect price to just turn around. Like I said, high liquidity stops price. Low liquidity will allow price to go through it. So, let me just leave this one here, okay? This one will be relevant later in the future, and we've already determined these here, right? Have we? No, we have not. Okay, so let me get rid of a couple of lines on here. There. And I'll run through the formation of the candles again. I'm trading to this level. That's it, right? I'm going to do that. Okay. Now you see there's a high liquidity area. Price is having a little trouble getting through these areas, right? See what happens? It's just ranging at this point. It's having trouble getting through. Dips down again, gets back into this area, and it starts moving up again, right? Now, let's see what happens here. Again, we have a high liquidity area here, high liquidity area here. That means, okay, that you have sell orders primarily at this level. So you could potentially get to this level, come up, and then start moving back down again. High liquidity areas at key levels are the ones that end up reversing your price, okay? So price comes up right to it, okay, immediately. Price comes down, makes this, and right here, price hits that, comes down. And like I said, this is a high liquidity area. It is a downtrend, right? The beginning, especially the beginning of the downtrend with a bearish candle, a bullish candle, downtrend, bullish candle with a long wick out the top. This is a strong resistance area, okay? And I'm not going to lie, this is a nice dip down here. I see it comes over here, okay? But we have to be honest about something. When orders start hitting here, okay, it takes time for price to really turn around. It always does. It takes time for price to turn around. This is a high liquidity area, and it's really narrow. This is a high liquidity area, and it's really thick. Like there's a lot of room here. So all of these orders were hitting these prices very strongly, and price carried up, turned around finally. Price finally caught up in its slow movement and then started moving down, right? So as price continues to move back down, again, you get back into this high level area again. So you can always leave these for your support and resistance levels. So let me go back to a different place on the chart, all right? And I want to show you, well, how about this? How about, like, you see this big move down here, right? Let's just kind of take a look at that. Gold took a massive drop right there. So let's just take a look at this, ranging market right here, right? You have a downtrend. Look at this candle right here. You have a downtrend beginning, okay, with a bullish candle. It's a downtrend. Once it completes and you start seeing movement up again, look backwards at the high and low of this area. You want to look at the top. You want to look at the bottom, okay? You want to find the high liquidity area. And since you understand what low liquidity looks like, you can negate those areas, especially if you're using a pivot indicator that is supposed to tell you where all the pivots are, right? Let me see if I can get it to do this. Let's see if it'll show up for me. Not really showing up for me. That's fine, because I'm backwards too many candles. So In a downtrend, it has completed. I start looking. I see movement taking place to the upside. So I find a downtrend with a bullish candle that has a long wick on top. This is where I want to start getting out of the market, okay? I do not want to try and target this pivot over here, because if I do and price gets here, I have to find some serious liquidity, right? I have to find serious liquidity that is going to get me above this price. And you can see what happens. Price comes down, hits this area, and it's having trouble getting through this area. It is high liquidity, okay? And it finally breaks through. It has to break through this area. Then it is above the area. The resistance becomes support, right? And how did it do this? Well, you have to find that you are in an uptrend, right? You're in an uptrend. Look for the bearish candle with a long wick on top, okay? Bearish candle, long wick, there it is. You can find it in ranging markets. So what happened here? You had a, right? I'm sorry, bearish candle with a long wick on the bottom. My mistake, bearish candle, long wick on the bottom. It's right here, that one. That's it. That's that candle right there. Bearish candle, long wick on the bottom. So you have this move here, and then this really tight move that takes place here, okay? You also have another one, which, and again, this is why it's better to do this on a larger time frame, okay, on a higher time frame. You find the key levels on your high time frame, and you can see these activities take place on any time frame, okay? And the reason you want to do this is because if you are using pivot indicators, you want to know where you're getting out at your price, right? Where do you get out? Here's a pivot here, right? Where do you stop trading? That's what you want to know. You get a pivot right here, right? So do you have a high liquidity area below this price, below here? Because at this point, you break below it. Do you have a high liquidity area? Well, you got to move up. You have to find a bearish candle in an uptrend, a bearish candle in an uptrend. And that has to have a long wick on the top, okay? Here's the uptrend. I don't see a bearish candle with a long wick on the top or the bottom. So I'm not taking this breakout. That's the point of finding high liquidity areas. There is no interest here in this uptrend. I'm not looking for it in a range. I'm looking for it in the uptrend, okay? So this will help you understand market structure, where to get your pivots out. You know, you want to break above them or break below them. You always want to be in between them. But if you can't find one below you, do not take that trade. If you can't find one above you, don't take the trade. Wait for the market to make one, okay? Because once it makes one, then you'll end up having one is made, price will come up, and it'll retest that area, right? And it will launch after that point. So if I look at this from a higher time frame, let's just kind of zoom out here, right? Like I said, you're in a downtrend. You want to find a bullish candle. I'm looking at this. You want to find a bullish candle with a long wick on top. You want to find one near the top, one near the bottom, right? So downtrend, long wick on top on a bullish candle. You got that. Downtrend, long wick on top of a bullish candle right here. There it is. That's it. So you found one near the bottom. Fine. You want to trade above this and below this. And look what happens to price, right? You get this. Retest, goes up, comes down and retests again, goes up, and it hits a previous level, just dances around and goes right through this area now because it's been mitigated. The price action and orders have been met. It's a decent area. But this area then becomes a support area. Anyone that gets broken becomes the alternate. Look what happens. Price breaks above it, and it becomes support, support, support. Big flooding move down. Now, I marked this one way back here, and look what happens in the future. Price comes way down here. Your target is right down there. And like I said, price action takes time to catch up. All of these orders had to consume this move. Finally takes precedence over the bearish move, and it becomes support again, right? So there you go. High level and low level liquidity in the market. Which one do you use? Well, again, that depends on what you want to do. Okay? So, any questions, feel free to drop it below. Primarily, I will answer you guys on the website. I'm sorry this was such a long video, but it is very detailed, and this is something that will really help you. Again, you do not need indicators for this. Okay? So, see you all next time at the coffee shop, and do me a favor. Go to coffeeshopcrypto.net, register with the website. There is a lot of activity taking place on those pages. You would not believe the amount of information that is being passed back and forth just from conversations that we are all having with each other, okay? And that's why I haven't been on this channel for too much, because there's a lot more going on there than there is over here. So see you all next time at the coffee shop, everybody. And yes, this little theory and strategy and formula will be applied to my SMC indicator. Peace out.